Power of sale listings across Ontario just hit a level we haven't seen in years. And the people on that list, not investors, not the speculators who stacked up pre-construction contracts in 2021. They are families with kids and two income. They bought when the bank said yes to everything. And now the bank is saying enough. By the end of this video, you are going to know three important things exactly where these power of sale situations are piling up across the GTA, a 4-point checklist to evaluate whether any power of sale property is actually a deal or a disaster, and if you are a first-time buyer, the honest answer on whether this is your entry point or a trap you cannot afford to walk into. The speed of power of sale indicates the rapidity of financial distress in the market. A spike in the power of sale signifies that homeowners are facing significant challenges, suddenly rather than gradually. See, the average price, the volume of sales, and the interest rate, we call these lagging indicators because they tell you what already happened in the housing market. But the power of sale listings, we call it as leading indicators because it tells you what about to happen in the housing market. Let's look at the numbers. In April 2026, the most recent month we have complete data for, there were 285 properties across Ontario publicly listed under power of sale. That is the highest number in 24 months. That means in 1 year, the number of homeowners being forced out of their properties by their lenders has doubled. But here's what shocked me. In March 2026, that number was 236. So in one single month from March to April, power of sale jumped 21%. This isn't a slow graduate build. This is acceleration month over month. More homeowners are reaching the point where they cannot hold on. When you see 20% month over month increase in distress signals, it's not something we can take it lightly. It indicates a trend developing in a real time. And if you are trying to figure out where the GTA market is going in the next 12 months, this is one of the only indicators that actually looks forward instead of backward. Now, let me translate this into something even more concrete. The average home price in the GTA right now is $1,058,000. Yes, it's down 3.9% from last year, but that's what TREP reports. It doesn't tell you what happens when someone who bought at a 1.2 million in 2021 with a variable rate is now watching their equity evaporate while their monthly payments have nearly doubled. That's the profile of the people on this list. They didn't make bad decisions. They made decisions that made sense in 2021, and the market moved against them. Let me show you where the pressure is building. The highest concentration of power of sale activity, it's actually in the 905 area. Brampton, Mississauga, part of Durham region, and pockets of York region. These are the communities where families stretch the furthest to get into the market between year of 2020 and 2022. The distress is concentrated in exactly the segment of the market that were most active during the pandemic buying frenzy. These aren't luxury properties. These are 3-bedroom, semi-detached or detached homes that sold for about 900 to 1.4 million at peak. Brampton alone accounts for disproportionate share of these listings. When a lender takes over a sale, they are not trying to get top dollars. They are trying to recover the mortgage balance. That's it. Every month the property sits unsold, they are losing money on carrying costs, legal fees, and asset depreciation. These properties move, and they move at a price that can look like bargains if you understand what you are looking at. By the way, I'm Ilham Ibrahim, a real estate agent here in the GTA. I help people navigate the buying and selling with a clear and confident guidance. And if you want to talk about your specific situation, you know where to find me in the description. Now, the question everybody asks me when this topic comes up, are power of sale properties actually good deals? The honest answer, sometimes, but not the way most people think. Let me give you a framework. 4 things that you need to check before you even think about making an offer. Because if you skip even one thing of these, you are not buying a deal, you are buying a problem. Check number 1, know the mortgage balance. The lender's break-even number is not the listed price. It's the outstanding mortgage balance, plus accumulated interest, plus legal fees, plus carrying cost. That total is their floor. So if the bank, let's say, is owed $750,000 and the property is listed at $820,000, the lender has roughly $70,000 of room before they start losing money. That gap between what they are owed and what they are listed, that's your negotiation window. Most buyers walk into a power of sale negotiation completely blind. They see the listed price and assume that's the number. But it's not. The number that matters is what the bank needs to recover. And here's the thing. Your agent can pull this from the listing documents. You don't need even to guess. You just need to ask. Check number 2. Run the comparable and be brutally honest with yourself. Before you bid, you need to know what similar properties in the same neighborhood have actually sold for in the last 90 days. Not what they were listed for, what they closed at. If comparable properties are selling for, let's say, $780,000 to $810,000, and the power of sale is listed at $820,000, you are not looking at a deal. You are looking at a property that is priced above market with extra risk attached for no reason at all. So the deal in the power of sale is never in the listed price. It's in the gap between what the lender needs and what the market will actually bear. If those two numbers are close together, or worse, if the lender needs more than the market value, walk away. The deal does not exist. Don't talk yourself into it. Checkpoint number 3. The condition report is not optional. Power of sale properties are sold as is, whereas you got no seller disclosure. The homeowners who are being forced out of their home have absolutely zero incentive to tell you about the mold behind the drywall or the roof that needs replacement next spring. So your home inspection is now the most important thing. $500 to $700 you will ever spend in your life. Try to go beyond the standard report. So if the house is more than 20 years old, bring a structural engineer. Scope the drains. Check the electrical panel. You are buying from people who ran out of money, and that almost always means deferred maintenance. Check number 4. Who is inside and when they are leaving. In most power of sale situation, the original homeowners still live in the property. The bank has started the sale process, but the occupants have not left. They may not even want to leave. So you could close on a property and show up to find people still living there. Sometimes they leave quietly, sometimes they don't, and sometimes the property is empty. But it's been sitting vacant for months, which brings its own problems. Frozen pipes, squatter's insurance gap. So an eviction, if it comes to that, is measured in months and thousands of dollars. A deal that takes 6 months to access, costs you $15,000 in legal fees, and leave you fighting just to change the locks is not the deal you thought you signed up for. Before you bid, know the occupancy status, know the timeline, and if the answer is unclear, price that uncertainty into your offer or walk. So here's the framework. 4 things: mortgage balance, real comparable, full inspection, occupancy timeline. If all 4 checks out, if the numbers make sense, the property is sound, and the path to possession is clear, then yes, you might have found something real. If even one of these 4 is red, walk, because here's what the data I showed you earlier tells us. These properties are not rare anymore. They are increasing month over month. The opportunity is not in jumping at the first one you see. The opportunity is in the being one of the few buyers who actually knows how to evaluate them. Now I know what someone's watching this is thinking, I'm a first-time buyer. I have been saving for years. Prices are still high. Interest rates have not come down nearly as much as everyone's predicted. If power of sale properties are where the motivated sellers are, shouldn't that be my entry point? Let me be real with you. For most first-time buyers, the answer is no. And I say that as someone who genuinely wants you to get into the market. But let me explain why. The first reason, a power of sale property comes with unknown cost. The inspection tells you a lot, it doesn't tell you everything. Something always comes up in the first year. Always a leak, appliance failure, a drainage issue that nobody flagged because nobody was living there to notice it. So if you stretch yourself to the absolute limit just to get in the down payment and the closing costs together, if there is nothing left after the keys are in your hand, you cannot afford the power of sale because the surprise expenses on these properties are not possibility. They are probability. Reason number 2, experienced buyers, people who have bought and sold 2, 3, 4 times, develop a gut instinct for what's wrong with the house. They walk into a basement and something smells off. They notice the fresh paint on one wall and nowhere else. They ask why the electrical panel was upgraded but nothing else was. As a first-time buyer, you don't have that radar yet. You are relying entirely on your inspector, your agent, and the documents in front of you. And when the seller is a bank that has never lived in the property and is legally protected from disclosing anything they don't explicitly know, you are operating with incomplete information. The gap between what a first-time buyer sees and what an experienced buyer sees is where the real risk lives. And on a power of sale, that gap is wider than on any other type of transaction. You are buying blind in ways you don't even realize you are blind. Reason number 3, most first-time buyers are using high ratio mortgages, meaning they are putting down payment less than 20%. Those mortgages requires the property to be insured through CMHC or a private mortgage insurer. If the property has significant deferred maintenance, and most power of sale properties do, the insurer can refuse to insure it. You could have your offer accepted, your deposited in, your lawyer lined up, and then you find out at the financing stage that you cannot get a mortgage on this property because the insurer says no. Don't put yourself in that position unless you've confirmed in writing that the property is insurable before you even write the offer. Now, I said for most first-time buyers, the answer is no. Let me tell you the narrow exception, because there is one. If you have all 4 of these things, 20% plus down payment, so you are not reliant on a mortgage insurance, a cash reserve of at least 20 to 30,000 after closing for the things that the inspection misses, an experienced real estate agent who has closed power of sale transactions before, and a real estate lawyer who reviews every line of the purchase agreement before you sign, then maybe you are not most first-time buyers. You are operating with tools most people don't have. But if you are missing even one of these 4, and most first-time buyers are missing at least 2, then power of sale is not your entry point. Your entry point is a conventional sale, a seller who still lives in the home, a property where you get full disclosure, a transaction where the person on the other side of the table wants the sale to close as much as you do. So here's where I land on all this. The power of sale data is telling us something that the average price headlines are not. There is a real financial distress building in the GTA, concentrated in the 905 area, concentrated among families who bought between the year of 2020 and 2022, and accelerating month over month. So power of sale could be a great opportunity. If this video helped you to understand something you didn't know before, like and subscribe, and thank you for watching, and I'll see you in the next video.